Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime Edition. On Tuesday's Stock Play of the Day, we talked about the XLE. That is an ETF that tracks the energy sector. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. On Tuesday's Stock Play of the Day, we looked at a long call in the XLE. I'm highlighting the play inside the options playbook. It was a very simple trade that we looked at. We had a pretty big down day overall when we were taping the Stock Play of the Day on Tuesday, but the XLE, the energy sector, was flat to up just a little bit. So we decided that we were going to go out further in time and we were going to buy an out of the money call option and limit our risk by basically, instead of buying 100 shares of stock, we were going to buy an out of the money call option and limit our risk to the premium that we paid for that overall. So let's see what happened in the XLE this week. If we look at this chart, the chart that I have up inside the Ally Invest charting platform, we have a 15-minute chart, and we're going to go to noon on Tuesday, which was the 28th. And you see that when we started, we were right just below 53 when we started the call. We always tape it live on Tuesday at noon Eastern time. So these are 15-minute bars, goes all the way through the day, up, down, flat at the end of the day. Once again on Wednesday, Thursday, a little bit more of a down day. And here we go on Friday, up, down, and now back to 53.05. So almost right back where we started. Now, if you see the range, the chart looks volatile, but the range is really only a point. On the low end, we're 52.50. On the high end, maybe 53.50 from the point that we put the trade on. So really not much going on, but the XLE is holding its own in this very volatile marketplace overall. Obviously, the NASDAQ has had a bad week, so a lot of the tech stocks aren't doing as well. Pharmaceuticals have been a little crazy overall. So the fact that we're just that the XLE is holding its own is, I think, a good thing just in general. So let's go and look at the actual trade that we did on Tuesday. So right now we see that 53.14 in the XLE. It's up $1. We went out to the January expiration. We erred on the side of giving us more time as opposed to less time, but we really we're really limiting the price that we wanted to pay for this option contract. And it was more a fear of missing out. There's been a lot of news as to what's going on with oil prices overall. We had a little bit of a climb up this week so far in oil prices. So we were looking at spending about $2.65. And guess what? We look at the option contract right now, the 55 strike, and you could maybe say we're up a few pennies. Before we started the call, we were actually up a dime. Now we're flat on the trade. So really nothing has happened overall. So on the overtime edition, we usually talk about an alternative. If you wanted to do an adjustment, if you were profitable, how would you get out of the position? If you were down, maybe it's time to just exit and move on. So nothing's ever meant to be a recommendation. We're always just trying to learn. And the overtime is definitely about learning because we're talking about adjustments. And every single week, we have something different going on, right, with the trade. Because based off of the options playbook, the goal of the Stock Play of the Day is to take all those 40 different strategies that are discussed in the playbook and try to find a strategy that matches the market conditions, more so than talk about the underlying in general. Obviously, Lindsay Bell gives very good overview of what's going on in the market and the fundamentals that are behind some of the underlyings that we're talking about, good or bad overall. But our goal is to try to come up with different ideas. Now, if I was long this option contract and the market is where it is, and we still have, let me just scroll up here, 112 days remaining to expiration, I would probably just remain long. Really, nothing has happened. So the trade is playing out. And if anything, it's a good sign because, as I mentioned, the markets have had a tough week and the XLE is holding its own. Now, we do have an update today, obviously, but the VIX is still north of 20, and there's still a lot of uncertainty in the marketplace, but we made it through September, and now we're getting into October, the second most volatile month of the year. So we'll see what happens. So it's a good news that we are now in the October month. Be nice to get through this without too big of a downturn overall, if we can. If not, why not? Let's get a positive month in October. That would be a great thing for the marketplace overall. So what would I do? I would normally stay long this call option, let the trade play out. We've limited our risk. We went out of the money. We didn't go in the money because we didn't want to risk that much capital. We went out of the money because of the current market environment overall. Now, if I'm a little nervous because the market didn't continue on up in the XLE, we didn't break out and continue on up to the upside, I could sell a call against this position. Now, on Tuesday's show, that question came up. If you sold a call, which one would you look to sell? And specifically, we talked about the potential move by looking at the long straddle for that expiration, which is the January 21st expiration. And we say, well, we want to be within that expected move. The long straddle was trading around $7 or so. Market was right around 53. So we said, I wouldn't mind selling a 60 call. Marketplace says it might be able to get there. So let's look at selling the 60 call. So to keep things simple, you could stay in the same expiration. If you were going to sell a call, that call's trading at about the same price that we talked about on Tuesday. So you would go on in and you would actually sell that call option. And then our long call position that we started with becomes a long call spread. That means that we only play between the strikes, which would be 55 and 60. Below 60, we can't lose anymore. Above 60, or below 55, we have limited and known risk. Above 60, we have limited and known upside. So now we're only playing in between the strikes, and we still have a lot of time to go on that position. Now, I don't mind that trade, except for the fact that we've gone so far out in time. I wouldn't mind doing a long call spread, but I don't think I would have went all the way out to January if I was putting this trade together initially. Okay, but it's an alternative right now after you've had a week of movement in the XLE and not much has happened. Now, I would prefer overall to go in and let me try to get back to the option chains and sell something near term. But there's not a ton of premium in the XLE. That's part of the reason why we actually bought an out of the money call, because implied volatilities were right around 30%. You look at the VIX index right now, it's trading right around 22%. So the XLE was trading about where the S&P 500 index volatility is, right? 7 points higher. So not a very volatile ETF, if you will. So buying out of the money option contracts was okay. We weren't paying a lot of juice for that option contract. Okay, so I digress. Let's go back to where I would look at selling an actual call option. I'm going to remove this one. Well, I guess I can highlight. Let me run down and look at the profit and loss graph here and just kind of show that if you did this and you did it right now, your profit and loss graph would be this colored line in the middle. Okay, that's as of today. So if you put this trade on right now, it'd be very similar to the cost that it was on Tuesday. But if you do get to move up to the 60 level, your profit might be underwhelming, if you will, relative to it being closer to the expiration date. So since we're going so far out in time, let me go and cut this. Let's go all the way down to 10 days. You're going to see this green line move closer to the dotted line, which is the expiration graph, right? Okay, so this is assuming this is just a theoretical number overall, but on the nearer term options, when you're looking at spreads, if you're correct on your forecast, you get paid quicker with that outlook, right? So I'd like to stay in the 14 to 20 day range as opposed to the 100 and I guess this would be 112 day range if I'm looking at long spreads overall, or I just don't do it, right? I buy a long call like we did, like for example. All right, so now let's go all the way down to 0 days to expiration. And you'll see that now that green line is morphed into the dotted line. And this shows you just over time. Now, it's a theoretical pricing calculator, so it's assuming that volatility doesn't change. It's just basically showing you what happens with time decay overall. Okay, now back to the chains. So what would I do to change this up a little bit? Let's remove this option contract. And I would consider this one. I'd be more apt to do it. Not a ton of time premium, but if we go up 35 days instead of 112 days, we can't really sell the 60 call. That's 33 cents. Well, it's not too bad. Maybe you sell that, but I would more than likely try to sell like the 58 strike call. Now, that's going to limit my upside because the width between the strikes is now only going to be 3 points overall. But I'm going to bring in 55 cents and I'm going to reduce my risk from, I think we paid $2.65 last week. So it would now be a cost basis on our long call of $2.10. That means our total risk would be $210 plus commission on that trade. So this would probably, if I did a shorter term one, I would probably sell this 58 strike call against it. But this also means that you now have on a calendar spread as opposed, well, actually it would be called a horizontal inside the options playbook. That means that you've sold a shorter term option and you bought a longer term option. So you need to be awake 35 days from now on November 5th and see where this position is at, because you might have to make that adjustment on that trade. Okay, so overall, when you're selling options and buying options that have different expirations, you add a degree of difficulty. And just want to say that this is a paper trade. If you want to follow it, I would put this position on and see how they act. If that nearer term option gets in the money, it's going to go against you faster than your long-term option is going to help you. And it has a lot to do with the dynamics of option pricing in general. That's it for this episode of Stock Play of the Day Overtime. Please click subscribe, ring the bell, and we'll see you this Tuesday on the next Stock Play of the Day. Thanks for coming, everyone.